In this video, you are going to learn how to control more money than you actually have. Hello everybody, my name is Linden Chasteen, and today I will be teaching you about LEAP options. LEAPS stands for Long-Term Equity Anticipation Securities, and they are essentially just an options contract with an expiration date farther than 1 year away. If you've never heard of an options contract, I'm going to give you a quick summary of what that is. An option contract is where you can buy and control the rights to purchase 100 shares at a certain price. So if you bought an options call, and a call is when you're betting that the price will go up, you say you bought it at $20, it goes to $25, you will get a percentage of the gains in between that $20 to $25. If that didn't make sense, let me explain it in much simpler terms. You buy an options call, the price goes up, you make money. A call is when you're betting that the stock will go up, and a put is when you're betting that it will go down. So the appeal of an option is that you can control 100 shares at a much lower price than the actual 100 shares would be. Now, this is an extremely incomplete and simplified definition of options, and there are tons of great YouTube videos that will teach you everything about options. But in this video, I'm going to teach you everything you need to know about LEAPS options. So let's get into it. So first, I want to say that I am not a financial advisor, so make sure to do your own research and come to your own conclusions. So a LEAPS contract is an options contract that is longer than a year. So basically, you're betting on the stock going up over that year, or however long the period of your contract is. By the way, each day your options will lose a very small amount of money. This is known as theta decay. So basically, when you're buying a LEAPS option, you really want it to go up in the next 6 months and not that year. So basically, you don't want to wait until the date of your options contract expiring, because then your option will expire worthless. So you want to sell in between that time. This could be 7 months, 2 months, 4 months, however long. When buying LEAPS options, you are controlling 100 shares of the stock that you pulled out that options contract on. So for example, if I pulled out an options contract on Dropbox, then I would own 100 shares of Dropbox. And the benefit of having the option is that you can get those 100 shares for a fraction of the price. So in this example, I would be paying $12.55 per share on that contract, but in reality, Dropbox shares are $24.29. That $12.55 will be multiplied by 100 because it's 100 shares, so this option contract will cost me $1,255. So if I had just bought those Dropbox shares outright and just bought 100 Dropbox shares, that would have cost me $2,429, but instead I got them for $1,255. Cutting your costs in half gives you the potential to double your gains. So if I only had the money to purchase 50 Dropbox shares, which would be about $1,200, I could just pull out a LEAPS contract and get 100 shares instead. This gives me control of double the amount of shares. This sounds amazing, right? Well, there are some downsides. When you're buying an options contract and the price of that stock that you pulled out the contract on stays the same or goes down over time, you'll lose all of your money. And this is compared to buying the stock normally. So normally, if you bought 100 shares of something and the price stayed the same, you would have the same exact amount of money that you started off with. But because the options contract decays over time, once it gets to the expiration date, it will be worthless. So you have the potential to lose a lot more money than if you just bought the stocks. This is why you really only want to pull out an options contract on a stock that you're very confident in. Now, longer term options tend to have less risk associated with them, and that's because stocks usually go up over time. Another downside of LEAPS options is that you only get a percentage of the profits than you would if you just bought the shares outright and got 100% of the profits. The amount that this percentage is measured by the Greek symbol delta. When buying an options contract, you really want to look for a delta that is over 0.88%. And this means that you'll basically get 88 cents for every dollar that your contract makes. The higher this number is, the better, but anything over 0.88 is a pretty solid delta. For example, the delta on this Dropbox call is 0.97. This means that for every dollar that your contract makes, then you will get 97 cents. Let's say Dropbox goes up $1 to $25.29, so that means that you will make 97 cents off that dollar. But you own 100 shares of Dropbox, so that 97 cents is multiplied by 100, therefore giving you $97. If you own the shares outright without the options contract, then you would make the whole 100. This gap is not huge, and the fact that you can double your exposure makes these contracts worth it. Now, options by nature are risky. They move much stronger than owning traditional shares because you have a lot more exposure, and this makes them more volatile. One last con that I will go over is that LEAPS options are more expensive than shorter term options, but the reason for this is because they're safer. Now I will show you how to buy a LEAPS options contract. I'm going to be showing you an example through Robinhood just because that's the easiest way to buy an option. So first thing you want to do is just go to your home page, click on the stock that you want to buy the option on, click trade options. It should be right about here. And then you're going to decide if you want to buy or sell, call or put. For the sake of this video, since I've been talking about calls, I'm simply just going to buy calls. And then you're going to want to go to in the money options. So you're going to want to go below the share price. And that changes with a call and a put. If you're buying a put, you're going to go above the share price because you're betting on it going down. But in this case, you'll go below. You want to change the expiration date to your ideal expiration date. Mine being January 1st, 2022, because it's a LEAPS option, so it's more than 1 year out. And then you're going to find the option that you want. All right, so this delta is 0.91, and so that is higher than 0.88, so you can go ahead and this one's good for me, so I'm going to buy this one. Click on the buy, continue, contracts. You can put in however many you want, but I'm just going to put in one. And as you can see, $1,275, and I'm controlling 100 shares of this stock. And then you just click review order and you're done. Overall, LEAPS options are a great way to make your money go farther, but they are risky, so make sure to do your own research and come to your own conclusions. Thank you so much for watching. I really hope this video brought you some value and taught you something new about options trading. If you want to learn more about investing, the stock market, or money in general, then I recommend you follow along with this channel by subscribing. If you have any questions about options, leave it in the comments below and I will do my best to answer them. Thank you and have a great day.